No, no, what am I doing? Not Zoom meetings. Where am I at? Ebook. Yeah, so if you're in your other classes, I put this link right in the ebook link. But if you're in other classes and you can't get your book, it's under tools. Yeah, it's not it's not obvious, but the BNC course materials under tools is what you need to click on. If you're in another class and you can't get your ebook, uh, and you have the Laker bundle, if you go to tools and then BNC, click on that, and it should give you a access
Oh.
code. Yeah, reveal the access code. Now, again, what did I just do? And I just closed it completely. Sorry. No. Maybe I should save it. Clears it out anyways when you turn off the computer. Yeah, so this the ebook thing, and I'm not sure what the link. I think there were only, like, at least in the past, we were only the second school to use that bundle thing. There's some school out in California that does it, so it's not real, obvious right now, but I think there's other people pick it up. But anyway, so if you go to the ebook, click on the BNC course materials, or you could go into, I think they tell you to go into tools of communication and click on BNC. But anyway, so those are course materials and the assignments and the exams. Actually, I'll put it in here. These are some of these you can see, some of them you can't yet, but all the assignments and exams are in there. The yeah, and most of the stuff that we do will be a lot will be in class anyways. Do a lot of this stuff in class, and the exams will be emailed to you. Just let's go to the syllabus. It'd probably be a good thing to do right now. The time to start? It is. It's past time to start. What am I doing? Okay, so let's see here. So tonight, we're going to do the starting at chapter 1 in investments. But before we do that, let's go to the syllabus. And the syllabus, I need to update this. This is the wrong website. The correct website's in Blackboard, or it's in the email. This is the wrong one. I found out today coming in here that this is my personal email or personal Zoom account, and it won't let me do it from the school here. So I gotta change that, and I'll send you guys out a corrected syllabus with the correct stuff on it. But let's go through the stuff we're probably the most interested in. All right, it's in class and remote. It's a hybrid class, and now some people, if you're an international student, some people need to have a certain number of classes. Now it's up to you which classes you come to. So, and some people are taking other classes that they already are getting the requirements in. So it really is up to the student to know which one, to know if they have to come to the live class. But I take attendance both off Zoom and in the live class. So whichever one you attend, I will take make a note of which one you attended. And yeah, so either way, you can go to class. These Zoom meetings are recorded. They're posted within 24 hours. Usually it's less than that, but within 24 hours they're posted. Grades for grading for the course. The assignments, the stuff we do in class are 20% of the grade. Most of it's done in class. Maybe a few things done outside class. And then the exams are 80% of the grade, and the exams are emailed to you. And they're emailed because there's different forms. So you will not find those in Blackboard. Exams will be emailed to you. And you usually got, what's today, Tuesday? I give you a week from Friday. So you usually have like, what, 10 days to get it in? So you should have plenty of time to get it in. Now, if you do miss a time, do not worry about it. Late work is accepted without penalty. But there will be a 0 in your grade book until you turn it in. So your grade might look bad, but you can still turn it in for full credit. So don't think, oh, I missed the date, I missed the date to turn it in. You can turn it in anytime. But your grade will look bad until you do turn it in. Question on that? So if you do miss a date, it's not the end of the world at all. Now, everything has to be in by the end of the semester, but you can still turn anything in for full credit all the way up until the end. And you know why I do that? I do that because these are the actual things for the class, the learning objectives. And what is, hey, okay. The learning, so as long as you cover the learning objectives, it matters less to me that you do it at a certain time rather than you do it in the entire course. So that's kind of my reasoning for that. All right, these are the chapters we're going to go through. The one we might not, chapter 4, we might not get to. We should get to these other ones. Here's a question for you guys. I didn't see it in the book. Do you guys ever have governmental accounting in any of your classes here? No? Okay. I didn't see any in the catalog, but I didn't know if there was other ones that were given. Okay, so these are going to be the basically what we're going to do. We're going to spend some time on chapters 1, a little bit of time on chapter 2, and then chapter 3 is going to take quite a bit of time. So this is going to be kind of the heavyweight. This one's going to probably take half the class, chapter 3. Okay, any questions?
So when I just look at your information, so after each chapter we will have exam, is it correct?
I'm sorry, one more time.
Okay, so after each chapter we will have exam, is it correct?
Yeah, you'll except for chapter 2 and 3, we combine. But yeah, after everyone, we're going to have a, well, here I can show you in Blackboard. So for instance, we're going to do the first one. First, chapter 1, we're going to do that today. Practice exam, we'll do that next week. And then there'll be a chapter 1 exam email. We'll start in on chapter 2, chapter 3, do some more problems in chapter 3, and then chapter 2 and 3 exam will be emailed. So other than, chapter 1 and 2 will be combined, but there's gonna be 3 tests in the class, basically. Screen was bigger. All right, any other questions? And if you have other questions, you can feel free to kind of we'll go over whatever if you think of any. Well, what I'd like to do next is just to go ahead and start in on chapter 1. Oops, okay. So chapter 1 is we talk about the equity method. And the equity method is what you use if you own a significant portion of your of a company. It has to do with ownership. Now, there are investment categories, and so what I want to do is go over the investment categories and see which ones we're talking about, how we split them up. Okay. We split up our investments basically between two different groups. We have debt securities, and then we have equity securities. Debt securities are when you lend money to a company, like bonds. And equity securities are when you buy ownership, like stock. So basically stocks and bonds is what we're looking at here. And these are the different categories. And the reason I'm going to go over them is because not everything fits into these categories. You know, I mean, not everything fits into the same category, I should say. Okay. So debt securities, we have three different rules for debt securities. Held to maturity, we hold it until the investment matures. So if it's a 5-year bond, we're going to hold it for 5 years. And by the way, this is all about management intent. So does management intend to hold it for 5 years? If they do, there's a type of accounting that we do is called held to maturity. Did you guys probably had this in other class, right? I would assume. Anyway, trading securities. Trading securities are securities that can be sold at any time. These are very short term. They could be sold today. You know, or within, say, a few weeks or whatever. But trading securities are securities that are actively looking to be traded. It might be, hey, if IBM hits $110, we're going to sell it. You know, so we have IBM stock. If it hits 110, we're selling it. And that would be a trading security. And by the way, debt securities, they have the same thing. They'll have a market value. If the market value goes up to a certain amount, you're gonna, you'll sell it. Available for sale securities. These are ones that are for not the entire length, but they could be for something in between. So let's say you have 5-year bonds. You're not going to hold them all 5 years. You're going to sell them in 2 to 3 years. You're not going to sell them immediately, but in 2 to 3 years, you'll sell them. You're not going to hold on to them forever for the whole maturity. So these are all debt securities. Debt securities have no ownership. So if you have a debt security for a company, like you give them a bond, when you buy a bond from a company, what you're basically doing is lending them money. It's like a mini loan. You give them a mini loan for, say, $1,000. They give you this bond. They're going to pay interest on it. It's a mini loan, but you don't own any of the company. Now, down here are what we think of as stocks. These are equity securities. You're buying ownership. Oh, I got this all down here. What am I doing? Why am I speaking so much? Okay, so debt securities, the criteria is the holding period. Are you going to hold it for, a week? Are you going to hold it for 3 years? Or are you going to hold it till the thing matures? So the holding period determines how you account for them. Equity securities, we don't worry about how long you're going to hold them for. We look at the voting rights of it. How much of it do you control? So voting rights are what do you control? Now, here's where it gets a little bit wonky. We have fair value. I have new, it's like 5 or 6 years old. I guess it's not so new anymore. But fair value is one of them. And that's generally for 0 to 20%, although I'll talk about that in a second. The equity method is what we're going to talk about next, and that's for 20 to 50%. And consolidations are over 50%. If you own over 50% of the company, you got to take both the companies and kind of smash the financial statements together. It's a little bit trickier than that, but the idea is you have to consolidate the financial statements if you own more than 50%. This method also uses the equity method, usually during the year. We'll get into that. We get into chapter 3, but actually, and in chapter 2. But they use so the equity method is not just for 20 to 50%. It's usually used for, 20 to 100%. Okay, now these percentages, these are not set in stone. The true criteria are these words that are in front here that are a little bit maybe somewhat vague. These are the true criteria for fair value. Means it's non-influential. The equity method is for things that are influential. And consolidations are for things that are controlling interest. Oops. Hey. So these are really the criteria that we are looking at. Now you say, well, how do we get these other? How do we get these percentages? When they issued the rules on this, the percentages were given as examples. They said, for example, if a company has more than 20% but less than 50, it's influential. These were simply examples they gave, but they were not actually part of the rules. They've kind of become part of the rules. If you're not told whether they're influential, non-influential, or controlling, you use the percentages. But it could very well be, though, that, for instance, a large company, if you own 5% of IBM, you're very influential. You'll have someone on the board of directors. So it really depends on how much influence you can have over the business. And again, these percentages, while they have become used, they're only used if you don't know whether it's influential or not influential. Okay. So the first rule are these ones in red. If they don't say whether that is the case, then you go to the second one. All right, let's do some of these. What page is this? Page 2. Debt securities. Purchase the 5-year treasury bond as an investment. Management intends to hold this investment for the entire 5-year life.
A. Hold to maturity. A.
Yep.
A.
A.
Good. Hold the maturity. We're going to hold the whole time. Number 2, purchase a 5-year treasury bond as an investment. Management intends to hold this investment for 2 years.
Available for sale.
Yep. Very good.
A.
Yeah. And again, like these trading securities available for sale, these words are not very descriptive, but that's what they use for, that's what they came up with. 3, treasury bill bond investment. Management intends to sell this investment within the next month.
Trading.
B.
B.
And now notice these are all the same investment. It's just how we're breaking it up is by what management intends to do with it. So management's intent is actually used for is actually used for how we account for it. What do they intend to do with it? The investment's exactly the same though. This is how long are they gonna hold on to it? Okay. Equity security. So these are stocks, and these are basically done on ownership, but also by if they're non-controlling, non-influential, influential, or controlling. Okay. Purchase 1,000 shares of General Motors stock as investment management intends to hold this investment forever.
Fair value.
Yeah. Yeah, fair value. This is probably 1,000 shares of General Motors stock. I'm sure they have millions of shares outstanding. It's probably not influential. So it's probably not influential. Purchase 1,000 shares of General Motors stock and intends to hold this investment for 3 years.
Fair value.
Yep.
No.
And not influential. Thousand shares of General Motors stock, and they intend to sell it next month to fund next month's payroll.
Fair value.
Yep. You might be wondering why I did that. Yeah, our teacher's an idiot. No, the reason we did it is to show you that it's not influential. It doesn't matter how long we're going to hold it for. It's going to be fair value. So when it comes to equity securities, it doesn't matter how long you hold it for. It's going to be fair value if it's not influential, and these are all non-influential. A good question. In this case, because General Motors is a very large company, they probably have millions of shares of stock outstanding. Someone who owns 1,000 shares of stock probably can't do too much as far as controlling the company. No, you take another company though. You take a small company that maybe they only have 3,000 shares of stock. It might be influential if you have 1,000 shares. So it really depends on the size of the company and how much stock they have outstanding. And they either have to tell you whether it's influential or not, or a percentage of ownership generally. In this case, the percentage of ownership is assumed to be quite small just because General Motors is a massive company. My guess is they have millions of shares of stock. Not more,
Professor,
Yeah.
could you describe to me non-influential to me differently? Because I'm not understanding that one part.
Well, for instance, General Motors, let's say General Motors, let's say 1,000 shares of General Motors. You probably do not have anyone on the board of directors. You don't have enough shares of stock to do that. So you cannot try to dictate what General Motors does going into the future. Let's say they're debating whether to go into electric cars heavy or whatever it is. That you can't control any of it. You're not influential. And again, it basically is, can you have any impact on management? Well, 1,000 shares is probably a decent investment. It's not going to be enough of an investment for a multi-billion-dollar company for them to pay much attention. If you said, I don't like what you're building, I don't like the color car you're making or whatever, it probably doesn't matter. If for someone who owns 1,000 shares of stock. Now, again, it's a decent size investment, and for an investor to be a decent size investment, but for the company itself, it's probably not influential. But again, if you owned, it really comes down to percentage at some point. But if it's a small company and you own 1,000 shares of stock equals 30% of the company, well, then you probably are influential. And it is a judgment call. It can be a judgment call, whether you're influential or not.
So question, Professor, for influential and controlling it, that means they have voting rights, correct?
One more time?
So for the equity method and consolidation for influential and controlling, that means they have voting rights, correct?
Yes, all these are for voting rights. Yep, exactly. And it's based on voting rights, and the voting rights, if you don't, if you don't have enough votes, basically, you're not influential. Okay. So let's go to some of these that are a little bit more tricky. Well, they were kind of tricky, but purchase 25% of LiveGo as an investment. Management intends to hold this investment for at least 3 years. Okay,
Equity method?
Equity method.
yes. And again, they don't tell us whether it's influential or not. Notice when we, where am I at? They don't tell us which one it is. So, they don't say it's not influential, it's influential. But if they don't tell us, we go to the second best thing, and that is to look at these percentages and you say, okay, 25% is in the 20 to 50% range that they gave as an example for the equity method. So coming back to here, yes, this would be the equity method. It's not controlling, so it's not going to be a consolidation, but it'll be the equity method. Yep. Okay, number 8 is a tricky one. Purchase 25% of 5Go stock as an investment. The management intends to hold this for at least 3 years. The other 75% of the stock is held by the founder of LiveGo.
Would that be
It will
consolidation?
be fair value.
Yeah, it really depends.
Okay.
Notice that whatever decision you make and whatever your input you want to give to management, you can be outvoted by the founder on every one.
Wouldn't this be consolidation?
For the founder, it would certainly be a consolidation, but this would probably be a fair value for the investment, whatever, who the purchaser of the 25%. Because again, the other 75% is held by one entity. And so whatever influence you would try to do, it could always be outvoted. Now, if the 75% was held by 10 different people, this probably would be influential. Because you can convince other people to do things, but in this case, it's held by the founder. And so this is one that's based on influence. Purchase 60% of the outstanding shares of General Industrial common stock as an investment. The management intends to hold. Yep.
Consolidation.
Yep. They own more than 50% of it. It's a consolidation. Okay, purchase 10% of the shares of General Motors. Okay, now 10% might sound small, but 10% of General Motors is probably in the billions.
So will be B, yeah.
It will be equity method.
Yeah, this will be influential. They have 2 officials on the board of directors, so they have someone on the board of directors that can voice their their concerns or their control of it. Number 11 is a tricky one also. Purchase 3% of the outstanding shares of Ford Motor Company stock as an investment, but only acquired 4% of the voting rights. Ford is a company that they have two different levels of stock. They have the stock that the Ford family owns, and they have all the voting rights. And then everyone else has some voting rights, but much reduced voting rights. So even though they have 30% of the shares of stock, they only have 4% of the voting rights.
Fair value.
Yeah, probably fair value. It really depends on what the makeup of the rest of it is, but most likely fair value. And, you know, again, Ford Motor Company, this is one of those things that they have where they, like I say, it's kind of strange that they have stocks with vastly different voting rights too. All right, number 12. Versus 3% of voting rights of Peabody stock is a short-term investment. Management intends to sell this investment when the stock price hits $80 per share.
Equity method.
Yeah. They probably are influential. It doesn't say whether they're influential or not, so you go to the percentages, and this would probably be the equity method. Okay. Equity method. So the equity method is different than the it's different than when if you're not influential. If you're not influential, whenever a company pays out dividends, you pick it up as income. You know, the company just sent you a check in the mail for dividends. Okay, yay, I got a check in the mail, and it's income. We view it differently if we're using the equity method. The equity method means that you own so much of it that it doesn't really matter if they pay dividends or not. It's simply like taking it from one piggy bank and putting it to another. You know, if you own for instance, let's say you own 100% of something, of a company, of you know, whatever it is, and if you take $10,000 out of it, you're no richer or poorer than you were before. You know, you got $10,000 cash, now your company is worth $10,000 less. So things like dividends and that don't matter as much for the equity method. We also don't care about the stock price. You know, the stock goes up in value to $80 a share or whatever it is. We don't worry about that because we own so much of it. It's sort of like if your car changes in value, how does that change your life? It doesn't. You know, you still go out and you get in, you know, and drive around, whatever. So it's a different kind of thinking, and the thinking is that you own so much of it that it's already part of your wealth. And the only way that you make money is if the company makes money. So if the company has income, you have income. It makes no difference about dividends or stock price or anything like that. Okay, let's see here. Okay. So how do we make income? We make income through making net income. So if the company that we own have influence over, if it has net income, that's how we get net income. We'll worry about these other two later on. Actually, we'll worry about all three of these later. So net income is money coming in. That's how you make money. Okay, the investment account. It increases with net income. Let me highlight the ones we're going to do first here. Hey, get out of the way, you. All right. Okay, so our investment account, we're going to have investment at a cost. And if we have net income, it'll go up in value. Let's skip these next two that are kind of wacky for right now. But we'll go to dividends received. Notice that dividends are minused. That's because you own the place enough of it that when you take money out of the company, yeah, you have more cash, but your company's worth less. So if you get dividends from your company, when you own it completely, it really doesn't make you any wealthier or poorer or anything else. It's just transferring from, you know, assets from one place to another. Okay. And let's skip all this. Let's jump and do some problems just to, it's sometimes going through these definitions until you see it, it's hard to picture until you see it sometimes. Okay, oh, I got a, yeah, sorry, you guys, I put an accounting 110, debit credit sheet in here. Okay, so let's say that they purchased 30% of Franco Corporation stock was purchased for $35,000 cash. So they bought 30% of the company. They don't say whether it's influential or not, but if they don't say it, it's in that 20 to 50 range. So we're going to use the equity method. Okay, so coming down here, let's see, we bought it for cash. So we have cash and investment. You don't have to put this in. But we have cash and we have another asset, the investment. Is our cash going up or down? Down. And our investment account is going up. Good. So we're going to be looking at, I don't know if I can even do this. Well, first of all, get in the right one. Our cash is going to go down with a credit. This is almost invisible. Why isn't that? And investment account will go up. Oh, shoot. Give me one more chance. Okay. Why is it doing that? I liked Word when it wasn't so helpful. It tries to be too helpful now. Okay. Well, it doesn't look exactly right, but that's what okay, so we'll put this in here. What date do we buy this on? January 1st. Okay, so our investment account went up. And again, you have to put this in. Asset going up by 35,000. Our cash account is going down by 35,000. So we're really just trading one asset for another here. And the reason we're probably doing this is that hopefully this investment will make more money than we're making in the bank, you know, just leaving the money in the bank. Okay, so here is where it gets wacky. The Franco Corporation paid dividends of $5,000 to shareholders. Okay, now we don't get all 5,000 of it. The total dividends paid to shareholders of 5,000. How much do we get? Yeah, 30% of the 5,000. Okay, so let's do the math first on this one. 5,000 times 30%. Is that 1,500?
Yes.
Okay, so we're gonna go out to the mailbox and get a check for $1,500 on May 23rd. So our cash is going,
As a plus.
yep. Oops. So our cash is an asset going up. And again, you do not need to put asset going up there. By the way, everything we're doing gets turned in. So this will get turned in. I don't know if we'll finish it today or not, but now here's where it gets wacky. So the cash goes up. Now, normally, if this was non-influential, you'd say, yippee, this is dividend income. However, we own so much of it that we simply say, okay, we took $1,500 out. Now our investment is worth $1,500 less. So this will come out of our investment account. Oops. Investment account will go down by 1,500. We're simply taking cash out of one investment and, putting it in our pocket or whatever. So we're no richer or poorer. It's just one investment went, or one asset went up and one asset went down.
Professor, it will not be the equity account, like investment equity account.
Oh, you mean, yeah, you may want to label, yeah, I know what you're saying. Yeah, so you may want to put this as equity, the equity method. Yeah, you can put it with the equity as an equity method. That's fine. And you probably would label it something along those lines. Yeah, because you could very well have the fair value ones and the consolidation investments and all that. Okay.
Would the entry for the 1,500, would that be treated the same way as retained realized gain
Uh,
on a
no,
income statement?
it would, no, it would just be shown as it wouldn't even, this would not hit the income statement.
Okay.
Yeah, and that is that is kind of the wacky thing about it, is that it's as if we just took it out of one asset and now our investment asset is worth $1,500 less. We have $1,500 more cash. Nothing has really happened as far as assets are concerned. So it's a different way of thinking. It isn't like normally when you get a check in the mail and you say, hey, yay, this will be, it'll go on the income statement as income, right? This method, it does not get counted as income. It just simply gets counted as reduction of the investment.
And then between January 1st and May 23rd, would there be a monthly closing entries showing an increase in the value of the investment that made it possible to do the dividend?
Generally not. They might do their, now, first of all, if they do pay out the dividend, they have to have enough in retained earnings as just as a regular business. But yeah, it doesn't have to show any any gains or anything like that in the investment at all. And we'll get to the income here in a second, but as far as the market value of the stock and all that, nothing.
Okay.
So if the stock price goes to 80, goes to 10, goes to 50, it doesn't make any difference. We don't do anything with it. So it's different. It's a different way of thinking. Is when you own so much of it that some of these things don't matter, like market price and dividends and all that kind of stuff. Okay, now net income does make a difference to us because net income is how we make money. That we own so much of the company. So on December 31st, now they may have been making monthly, financial statements. So this could have been something that went throughout the entire year. But we'll have net income of 20,000, and we don't get all of that. We get 30% of it. I'm going to copy and paste. Part of my job is to teach you guys to be lazy like me. So $20,000 times 30% is
6,000.
6,000. Thank you. Okay, so we are going to pick up 6,000 of this as income. So when they make net income, we make net income. And that's really the only way we make, income is if they make net income, just like a regular, a business, like on an income statement. So,
Investment income,
I'm sorry?
investment income.
Yeah, if I some kind of investment income. They might say equity income, equity and income. There's different terms they might use for it, but this would be basically you're showing your income. And now you're saying, okay, wait, our investment now is worth more. Our investment is worth $6,000 more. For our investment, equity. Oops. Asset going up. And notice that there's no cash in this thing. We pick up the income based on if they make income, not how much cash they gave us. So it really is, if you, see something here. If you remember way back when we did the, good markers? Oh, yeah, yes, markers, of course. If you remember way back when you did the, you made your first accounting, here, you did retained earnings. We had a retained earnings statement and we would add in income and subtract out dividends. And then we get our ending retained earnings, their beginning, this would be our ending. It's the same thing. One thing you guys have probably learned by watching this is why I do it on the screen rather than board anymore. But if you look at this, so their income, this case would have been plus, their share of it would have been plus 6,000. Their dividends, minus 1,500, it'd be exactly the same idea. They own so much of it that it's like they own this company. How does this company make money? They make money, the income. They reduce the value with dividends. See here. What is the ending balance? Oh, I think I left enough room there. I'm gonna have to consider here. What is the ending balance in the Franco company? Okay, well, it started out, the investment had, oops, let me get down. Uh, 35,000, I think it was. We had net income of
6,000,
I'm sorry,
6,000.
6,000, yep. And we had dividend. And so it really is just like back in accounting 210. So our ending balance in this would be need more space here. What is that?
39,500.
39,500. Thank you. So this will be our ending balance in it. And again, it goes kind of like back to when we were doing, you know, in counting 1 or 210. Income comes in, the dividends go out, and you're left over is what you left over with the ownership, and it's the same thing. Which is kind of why they call this the equity method. You know, retained earnings is part of the equity. Right? So the equity method is, what does it do to the equity part of your financial statement? And again, it's when we own so much of the company that we're influential, and that we own so much of it that it's sort of already become part of our business, whatever it is. Okay, you guys want to try this one on your own? Number 6. Yeah, we'll try this one on our own, and we'll take a break after. How about? Let's see if you can figure this one out. And again, it's 40%. They don't tell that it's influential or not, so it's between the 20 and the 50. By the way, also, I'll show you guys how you make out the computer in here is not activated. So I'm gonna, if you go into email, Word, Excel, it has all the applications, but it also has, in this case, it has a calendar and bookstore and all that stuff. It also has tech support. Oh, this is for students, I think. Alright. Oops. %.
Cash to investment,
That's right.
cash to investment.
Yeah, so so our cash is gonna go down. This one's a little trickier. This is 25,000 times. %. 10,000.
Then
And so this one is I didn't even change the date on that one. This one is, so our cash is gonna go up. 10,000. But again, we don't feel the happiness because this is actually, we own so much of it, it's just taking it out of our investment. Our investment's now worth $10,000 less. And that test, this is probably the one that gets missed the most. Is the investment. It's so tempting to put it in there as investment income. But it is actually a reduction. Okay, and they had income of $12,000.
Before 4,800.
For 4,800, you said?
Yep.
So we have 4,800 would be our share of it. Okay, so this would be oops. Asset going up. And investment income is also going up by 4,800. I'm going to say something odd about this method. Not that you don't already think it's odd, but so here's what's kind of say different about this method than the other many other methods. You'll notice that the investment account is in every single journal entry here. Now, there's always another account with it, obviously, it has to balance, but the investment account is in every single journal entry. So really, when you're trying to decide what to do with this, the only other, it's trying to figure out what the other side is, but the investment account is in every single entry. So if you make a journal entry, it doesn't have the investment account, you may want to look at it again. Okay, cheat. Now this one is, I think they paid out more in dividends than they made. So this is gonna be losing money, so this is 80,000. Income was 4,800. And dividends were
And
10,000. Some 480, you said? Oh, 800, I'm sorry. All right, hopefully that's right. Yeah, so this, it went down in value. Why did it go down in value? They had less income than they paid out in dividends. All right, let's stop here. Let's come back at, I got 7:02 here. That clock is doing something different. Oh, I it's daylight savings time. So this will be, they be back in 10 minutes. So be back at, I got 7:02 on my thing here, so I'll say 7:12. 7:12 according to this clock. Go ahead and take a break. Okay.
I'm not getting the audio.
I apologize for those. I just started talking to the class here and I left you guys out. I apologize. All right, so Tom buys an oven from Sarah for $700. Now Sarah had it on her books for $460. How much is Tom going to put it on his books as?
700?
700. So his cash is going to go down. Keep doing that. So his cash is going to go down with a credit. And the equipment is going to go up by 700. I gotta take this out. All right, so January 1st. So it'll look like this, equipment. Say oven. You don't have to put that in, but an asset going up. And it doesn't really matter what Sarah had it on her books for. Tom paid 700 for it. Okay, so prepare the journal entry for depreciation. The oven on December 31st, assume that the oven had an estimated life of 10 years.
Professor, can you go back, please?
Yeah. You don't need to put this in up here. This is. So yeah, so this is our journal entry for the oven. Again, he puts it on the books for what he paid for it. It doesn't matter what Sarah had it on her books for. Higher or lower doesn't matter. He paid 700 for it. He puts it on the books at 700. December 31st rolls around and they have to do a depreciation on it. And the depreciation is if it is for 10 years with no residual value. Okay, so 10 years, no residual, so 700 divided by 10 is,
70.
Yep. Oop. So depreciation expense, 70,
Accumulated.
and accumulated depreciation. Oops. Oops. Is 70. There's a morbid way to remember this journal entry. You guys, I don't know if you guys had to. At the end of its life, it's dead. EE. AD. And that's for all depreciation entries are DEAD. I wish it was something else, but dog or something. But all right. So this is depreciation expense. Okay, what would if Sarah had kept the oven, what would her depreciation expense have been?
700.
It would have been
460 divided by 10.
Oh, yeah.
yep. So it'd be I'm
Ooh.
gonna copy this down.
46.
So if she had kept it on her books, assuming it had the same life, 460 divided by 10, so hers would have been 46. Would have been her depreciation. So what would the impact of Tom's depreciation been versus Sarah's expense on the restaurant's income? Okay, so what's 70 minus 20, the 24?
Yep.
70 minus
Yep.
46. Oops. It's 24, right? Oops. And this is going to come into play here when we're in a minute. So Tom is going to be depreciating $24 more than Sarah would have, right? So here's where this comes into play. If Tom buys part of Sarah's corporation, he's really buying part of her assets, part of the assets, and he's buying them at the fair value, which in this case would have been 700, even though it's on the books at 460. So we're going to have to adjust the income because there's excess assets on his portion of whatever he's buying. Now, in this case, it's 100%, so we don't have to, it's kind of academic here because he bought the thing completely, the oven. But if he was buying a percentage of it, of Sarah's restaurant, how much of it would have been his, to pick up as extra expense. Let's do one and see how this works out. Okay. I tell you what, let's do the easy stuff first, the stuff we already did. So Signals Corporation bought a 25% interest in the Calhoun Corporation on January 1st, 2024 for $55,000. The Signals is able to exert significant influence. Okay, so this, even if you didn't have the 25%, this one would be more important one anyways. It's influential. Oops. And Calhoun had net income of 30,000. Okay, so let's go ahead and do this first paragraph we can do already. We'll worry about this later. So let's do this first one. So the investment was for 55,000. Oh, I just gave a big old. That's how we used to have them. They pick the CPA exam and they give this green paper that had all these tiny little lines on it. So that's where this comes in. All right, so this would be so January 1st. You buy it. Investment. Equity method. Keep it going up. 55,000. Okay, cash is going down by 55,000. All right, let's take care of the income. I'm gonna put a header on this. Say year end, I guess. 12/31. Okay. Okay, so how much of the income are they gonna pick up?
It will be 30,000 times 25%.
Yep.
So it will be 7,500.
Very good. So 30,000 times 25%. $7,000. Oops, 500. Okay, now this is income. I should have done dividends first because we did dividends on the other one first, but income. This is investment
Investment.
income. Oops.
Yeah.
And what goes on the other side?
Investment equity.
Yep. We're always going to have that investment equity account somewhere in here on every entry. So our company made income, our portion of it made income. Oops, don't do that. And so we made income. Let's do the dividends. I'm gonna run out of space. I might run out of space here. Yeah, well, we're all friends here, right? All right, so this is So dividends were 12,000. So we're gonna pick up. So 12,000 times 25%,
4,000.
3,000.
Yeah, they have 3,000. I'll do the easy part. You guys can tell me the hard part. Easy part is cash is going up. 3,000. And now for the wacky part.
Investment.
Investment equity.
Investment equity, again, it's in every single one of these. It is going down. Our one asset is going, our asset of cash is going up, but our investment is now worth, oops, is worth 3,000 less. Kind of like if you took $3,000 out of your piggy bank. Yeah, you got $3,000 in your hand, but your piggy bank is now $3,000 lighter. Okay, now let's come up here for a second. So here's the carry values. And then here's the fair values. What these lines are. It's probably helping me somehow. I don't know. All right. So the carry value. So here's the fair values. Now, when we buy a company, we're going to be paying the fair values. You know, just because they have something on their books for less money, you know, this building maybe they have for 200,000 and maybe it's really worth 240. So we are really buying it at the fair value. Okay, so here's the carry value is 370. The fair value total assets is be 40 more than that, right? $410? I think it's 410. Oops, not that. That. So the fair value of the assets were 410. The liabilities were the same, 150 and 140, so this would be 190. Okay, now we're going to come up with our net assets, and we're going to at fair value. So this is called Calhoun Company has 410 worth of assets at fair value. Their liabilities are 190 at fair value. So this is the plus, this is the minus. So the net assets are basically what's left over. So 410 minus the 190.
220,000.
Yep.
220.
And by the way, if you're wondering where that
55,000.
came from, is that 55,000 came from as being 25% of, oops. You know, that's how this number came about, 55,000. It's 25% of the fair value of the company, which is 220,000. Okay, now notice that when Calhoun calculates their income, they're going to be depreciating the buildings at 200,000. When we bought it, our share of it, we value those buildings at 240,000. So we're going to have to put what we call excess assets on the books. Oops. And all these are the same except for the building, which is 40,000. An extra 40,000, I should say. Now, here's the question for you. Did we buy the entire building? No, we only bought. Well,
We
yeah,
depreciate
no, yeah.
building.
So we got 25% of it. So our share of this is actually going to be 10,000.
Professor, we don't do depreciation on building,
We're going to be doing depreciation. Yep.
so it will be like 40,000 divided by 5 years of depreciation life.
Is it 5 years? Yeah, you're right. It is 5 years. Yeah. So here's the excess. I'm gonna copy this down here. Oh, that'll probably make a mess of it. And you know what? Hold on, let me. I'm gonna grab a few extra rows here. Okay, so we're gonna do this building. The building, excess building will have a useful life of 5 years. I'm gonna copy that down here. Okay, so what we're gonna have to do is increase our expenses. Because we're gonna be depreciating this building as if it's worth 240,000. Our share of it is 10,000. And so we're gonna do that over, what's it, 5 years? Okay, so is that 25% share? Ah. So 10,000. Stay a building. 10,000 divided by 5 years. The 2,000?
Yes.
So we're gonna have to depreciate, take out of income, basically $2,000. And we're gonna do this for the next 5 years. Okay. So let's take a look at our income. Here's our investment income. Or it was $7,500. And it was a credit. But we're looking at this and we say, wait, we got to depreciate more. We actually bought part of that building, 10,000 of it. Our share of that building was 10,000, the excess. And so we have to depreciate that extra that Calhoun does not have on their books. So how are we going to do that? If the investment income is a credit, how are we going to deal with this reduction of it? So here's the investment income, 7,500, it's a credit. So if we have to reduce that by 2,000, is that gonna be a debit or credit?
Debit.
Debit,
Be a
good.
debit.
Debit.
Yep. So we're gonna take it out of investment income.
Um,
2,000. It's gonna reduce our income by 2,000.
mhm. To investment equity.
Yes, good. Again, we have to take it out of our. Because we just depreciated our building on there an extra $2,000. So this would be asset going down. So this extra depreciation will reduce our income by 2,000. You want to ask for the ending balance on it? What knucklehead made this?
Wouldn't the depreciation that Calhoun takes be factored into arriving at their net income? So aren't you reducing it twice? Because it's reduced to get to what is your income, investment income, and then you're reducing it again by the excess asset.
Yeah, but it's only for the excess, I'm sorry. Only for the excess that we're doing this extra depreciation on. So this 200,000 is included in the 240, but there's an extra 40,000 in there. So it's only for the excess. You're right that they would do a depreciation, some kind of depreciation for the 200,000, right? And which is fine, but we're gonna do it on 240, so there's an extra 40,000 that isn't being depreciated. For example, if they depreciated this down to 0, the fair value, you know, if you would to put it on the books of whoever bought it, would still have 40,000 sitting on it. You know, because they wouldn't depreciate enough of it to go down to 0. So if you went through the entire life of this thing, whatever it was. So we're only doing it for the excess and only for our share. So this is the excess amount, and it's only for our portion of it that has us. Now, by the way, Calhoun Corporation, they're not going to do anything with this. They're going to, like you said, their depreciation is going to be based on the building at 200,000. They don't care what we, you know, what our investment is in it and how we keep, you know, we keep the books for it. They don't care. But we know that we picked up an extra $40,000 of total assets. Our share of it is 25% of it. So we're going to depreciate, we're going to do excess depreciation of our portion of it, of the excess. Now, again, that 200,000 is included in the 240, you know, those are basically the same thing, except that one's larger than the other, and we're going to be writing it down for our portion of it. And eventually, after 5 years, we're not going to write off any more of it. It'll be down to, this will be down to, you know, the excess will be written off over 5 years. But yes, there will be depreciation expense for the carry, you know, for Calhoun. And again, Calhoun's going to be using the carry value. Calhoun's not going to worry about the fair value. They can't actually. They can't write their books up to 240,000 on the building. International standards you can, but U.S. standards you can. Yeah, so this will be for our share of that excess. We're going to have to depreciate an extra $2,000.
What happens when Calhoun sells the building that they're depreciating that.
If they were to sell it, whatever excess would be on there would disappear. And that would show up as a gain or a loss on their financial statements, and we would take 25% of it.
Okay.
Yep. And again, they're not gonna care what we do on our books. You know, when they sell it, they would base their gain on the 200,000, not on a 240, whatever, you know, whatever they got for it, you know, it would work out as being in their income somewhere as a gain or a loss, and we would take 25% of it. The same problem? Similar.
If say the year after they bought their 25%, the, fair value of the equipment increases, are we then able to take an excess value
Only at the time of purchase.
only at the time?
Again, international standards, they do have ways that they allow that. And they do it for a reason. Well, let's take buildings. Especially a building that you've had for a while. You got this building you bought 30 years ago and you paid 200,000 for it. And now it's worth 6 million. Okay, and that's not that uncommon. You find an area that is really booming or something. US standards, you keep it on the books at what you paid for it, which is kind of a ridiculous number. You know, 200,000, they may be taking that much in a year in rent. So international standards, they say, no, you can, you know, it's disclosed, but you can write it up to the fair value. And also that's a better judge of how management's doing with the building, because while at 200,000, they may look wildly profitable. At 6 million, maybe they aren't. You know, maybe they're not utilizing the building the way they should. So international standards allow US standards, we like the historical cost because you can actually go back and look it up. You know, you can see exactly what it was. Sometimes though, you get a ridiculous number that it doesn't mean anything, you know, because like I say, if you have the books for 200,000, it's worth 6 million. It's a crazy discrepancy. Okay, so let's go ahead and do this one. Okay, we should get a, well, first, the net assets are a fair value, came out to 190. They bought 30% of it, so that's how that 57,000 came about. They, the net assets so here's the fair value of the assets, here's the fair value of the liabilities that they gotta pay off. So what's left over is the 190, they bought 30% of it, so that's that 57,000 came out. Okay, now the equipment. The 50,000 for the equipment. That is for everybody, but we only bought 30% of it.
$15,000.
So our share of the excess assets are going to be 15,000. So part of our purchase of it is that extra 15,000 that is included in our 57,000 that we bought. Oh, don't do this.
Oh.
Okay, so here's our excess equipment. Equipment will have an excess useful life of 3 years. Oops. Okay, so
Excuse me. I
yeah,
think that there is wrong.
did I put something wrong up?
Maybe not. No, sorry.
Okay, well, don't be shy about telling me if I do something wrong. Every now and then our students will say, well, how'd you get this number? They'll come to me after class or something. I say, well, because I'm an idiot and I gave you the wrong number. So yeah, definitely check my numbers. Okay, excess equipment. So the excess, our share of the excess was, so 50,000 total excess for the equipment. Our share of that is 30%, so 15,000. So in other words, there's 15,000 of this purchase price, is it? Hey, what is? Oh, here we go. Of our purchase price, 57,000, 15,000 of it is included in that. Because there's an extra 50,000 sitting in here, and our share of that was 30%. So this is actually sitting in that 57,000. If there were no excess equipment, this would be whatever. Yeah. Yep. All right, so coming down here, 15,000. So 30%. Oops. Share of excess. Um, 15,000 divided by 3 years equals 5,000. All right, so again, we have this debit. No, we don't. We have a credit for our income of 30,000. The credit, so we have to reverse out 5,000 with a debit. Oops. Turned up my caps. And we're gonna do that for the next 3 years. And the other account,
This one?
yep. So it'll reduce the investment equity by 5,000. And it'll do it for the next 3 years. Let's stop here. And I think I'm just gonna, let's, I want to make sure everybody can get into the textbook and all that kind of stuff before we go. We'll finish up this handout next week, and then also next week we'll have the practice exam for chapter 1. And then we'll probably start into chapter 2. Chapter 2 starts out easier and then it gets wacky. But so next week we'll finish this up and we'll have the practice exam, and then I'll send out the exam next week for chapter 1. So we'll get that out of the way. And then we will start in on chapter 2.
Is there will be any MCQ in exams?
Any homework?
No. In exam 1, do we will have multiple choice questions or no? Like we did like a fair value, equity methods and all.
So, I'm sorry. Oh, this is for save up here. I'm sorry. Oh, here it is. Well, don't turn anything in yet. Oops,
So there will be no deliverables for the next week, right?
correct.
No exam.
So here's what we're gonna do. So this equity handout won't be won't be due till the 22nd. But so next week we'll finish it, and then when we finish it, and by the way, if you're doing this by hand, there's absolutely nothing wrong with doing it by hand or doing it on notebook paper. You can turn it in any number of ways. You can turn it in by, like what I'm doing is putting it right into the document itself. You can turn it in by taking pictures of your handout. You can turn it in by doing it on notebook paper, taking pictures of the notebook paper. In class, I can check it off right in here. So if you do come in next week for class, I'll check it off in here. You don't have to turn in anything. I'll just put it right into Blackboard. But if you're doing it in the Zoom meetings or remotely, any way you turn it in, and I want to show you something else really quick here on the assignments, and that is these the assignments are unlimited attempts. So 2 things. If you want to take 5 pictures and turn in 5 pictures, you can. It's unlimited. Also, if you turn in the wrong thing, let's say you turn in the wrong thing. Oh man, I turned in the wrong handout. You don't have to contact me and have me take it out or anything like that. Just resubmit it. Now, if I see it and I see there's 2 submittals, I usually go to the second one thinking that's the one that they probably wanted to turn in the first place. So you don't have to contact me or anything. Just submit the one that you want to submit, and it'll go in there. The only thing that is a no-no, and if you look underneath the submitting work, wait a minute. The only thing that you really can't turn in are these. It's very tempting if you have 10 pictures to put them into a zip file and send it and put it in Blackboard. If you do that, Blackboard doesn't know what to do with it, and it kind of just like locks in there. And or page files if you're doing Apple. So don't do zip files, don't do page files. If you have 10 pictures, submit 10 pictures. And you know, for whatever reason, Blackboard does not like zip files or page files, but any way you turn it in online is fine.
Professor, can you go back to where you attach, where you can submit it through attachment?
Yeah, exactly, the assignment, how to do it.
Let's see here.
I think your screen is kind of huge. Okay.
All right, so yeah, so in here, so here's the handouts. So if you ever need the handouts that are there, these are learning out, we have to do that. But when you want to turn it in, you'll click on this. And it'll say, you know, you want to upload files. You
Okay.
can also, you can create it, but you can upload the files and then attach the files in there. And again, if you have 10 pictures, attach 10 pictures to it. And then hit submit and it'll go in. So you click, yeah, so you click on the heading itself. So where it says accounting for 14, chapter 1, just click on that and it'll take you in there.
So you want us to stop here and we'll continue on the next class?
Yeah, you don't need to turn in anything today. Next class we'll turn in both of those. And so then and those of you that are in class next class, I'll go ahead and check them in class. And let me do one before anyone leaves. Let me make sure I got everyone online for the Zoom. Let's see. I'm not sure. I do. Okay. Any questions?
Yes, I have a question. So everything what we did today, the handbook, what we did, so it's our assignment?
It'll be turned in, yes, in the assignment next week.
Also, there is no another assignment like from the McGrave Hill or something?
No, when you turn it in, so far we did up through round number 9. There's only 2 left here. But we'll do those 2. This one will get turned in, then we'll do the practice exam for chapter 1 and no, it's chapter 1. And that'll get turned in. So here's the practice exam. We'll do that next week. We'll do that one together. That'll get turned in. And then I don't have it, you guys can't see this, but the chapter 2 will be available next week and we'll start in on chapter 2. So next week we'll turn in 2 of them. I like the first week, I don't like to have a bunch of stuff to turn in because a lot of people can't get into they can't get into the textbook, they can't get into Blackboard and all kinds of stuff. So
And the chapter 1 assignment due is on the 22nd and our next class is on the 19th, right? So we are meeting before our submission.
yep.
Got it.
Yeah, it'll get in there. It'll get in there. Any questions?
No
Well, if you do have questions, you can go ahead and email me too, and then they can do it that way. But if you have any questions, I'll certainly take them. Oh,
No, thank you, Professor.
Thank you,
Yeah.
Professor.
All good, Professor. Thank you.
oh, okay. That's my Zoom meeting. There it is. All right. Okay, well, I will see you guys in a week. And yeah, and again, you don't need to do anything else. We've already did up through 9 in the handout. We'll do the other 2, and then we will go ahead and do the practice exam next week. Well, once you get your first test, I think you'll be okay. You know, it's always nerve-wracking until you get that first test in. But so next week I'll send out the first test.
All right, thank you.
Awesome.
Professor. Have a good
Thank
night.
you. Good night.
Good night.
at home and then.
Thank you. Good night.
Thank you. You can actually, if you wanted to do it at home or bring it into class, that's fine too. I'll take it either way. Yeah. Huh?
But this week, like, will you give like handouts of the exam and then you have to write it down?
I can. I have no problem doing that. Yeah,
Like, it works on the laptop too, right? So it's fine.
either way. Yeah, however you want to do it is fine with me. I can bring in the paper copies of it and then you have it filled out. There's gonna be different people that have different forms. As long as you turn in the form that you were given, yeah, that's not a problem. Yeah.
Thank
Bye, Professor. Good night.
Good night.